think, let's see, it does seem that mic probably is working. So that's excellent news. That's at least a very good starting point for talking on the stage. First of all, thank you very much for coming and joining us. We'll see how the session goes, but we're going to talk about a really important subject today. We're talking about climate-friendly portfolios, because if we are to address issues like climate change in particular, we're not going to be doing that without the investment market coming with us. And of course, climate-friendly portfolios are the client-facing end of that, which is where individual investors have the opportunity to select according to their views on climate change and other issues, or of course not, and far too many people kind of don't at present. But today, in events like this are very much aimed at raising awareness and helping people to understand what funds do and don't do. So without further doubt, further hesitation, I'm going to ask our panel members to each introduce themselves. Dan, can I start with you, please?
You certainly can, Julia. Hi, everybody. My name's Dan Russell. For the next 3 days, I'm the Chief Commercial and Marketing Officer at Fintel, which is an organisation that works between financial advisors and product manufacturers to provide the technology, the research and the infrastructure to try and make the market happen. And in 3 days' time, I'll be doing something completely different associated to financial understanding. Anyway, over to you guys.
Hi, good afternoon. My name is Mathilde Mesnard. I'm Deputy Director for Environment at the OECD. That means I work at the level of public policy, advising countries on their public policy.
Thank you. Hi, I'm Randeep. I work at M&G Investments, and I work on our sustainability mandate, specifically our Paris-aligned strategies.
And last but not least, my name's Tessa Younger, and I work for CCLA Investment Management.
Oh, the mic needs to be closer to your mouth, Tessa.
Can anybody hear me? Could you raise your hand if you can hear me? Oh, some people can. Good, sorry. Tessa Younger. I work for CCLA Investment Management. We are one of the largest fund managers for not-for-profit companies. And I'd say our approach to investment is really the kind of thing we're discussing today, climate-friendly investments. And if it was the finance and investment industry that built the fossil fuel infrastructure that we have today, it's the same industry that's going to be able to build our decarbonised future.
Fantastic, thank you. So as you'll see, what we've got here on the panel is a range of people from the financial advisory, sort of very close to the client edge and investor edge, through to national level, understanding what goes on at a country level, and then 2 fund managers, one very large generalist fund manager that's got a really strong specialism in this area, and another fund manager who's focused almost entirely on this area. So we've got a really good range of people to discuss this, to get the different angles and to pick up on the different aspects of this area. But perhaps we can start off by saying, well, okay, when we talk about climate-friendly portfolios, what exactly is it that we're talking about? Mathilde, if I can ask you to start perhaps by talking about from a country level, sort of national and international context, what is this and how does it touch, if you like, the clients or the investments that a fund might invest in, a client would then ultimately buy?
Okay, so I will come from, the Paris Agreement, almost 10 years ago now. That was, all the countries somehow agreed on a trajectory towards net zero. But this to happen, there was one article, that's 2.1c, speaking about aligning financial flows. Because without that, nothing is happening. And we have done a review at the OECD last year about asking ourselves to which point the capital flows are aligned with a net zero trajectory. And the answer is a big no, they are not. They are very far from being aligned. Well, we still have a lot of data issues to really be able to have a clear view on that. But for what we can see, it's not aligned. It's very far from being aligned. So, and I can give you a couple of data just to illustrate. Clearly, like in 2022, so now 3 years ago, the investment in clean energy began to be bigger than the investment in fossil fuels. But still, in terms of stocks, the fossil fuel stocks, the listed equity invested in fossil fuel is still 2.5 bigger than the one invested in renewable energy. The banks still continue to invest much more in fossil fuels than renewable energy, etc.
Investment was going up,
of course, it's improving. Thank God, it's improving. But we are far from being where we need to be. And this year, all the countries have to renew their NDCs. That means their commitments to net zero. But these commitments have to increase the ambition of countries, but nothing will happen if the flows, the financial flows, don't go in this direction. So this is the critical question, how to make sure that this portfolio begin really align with the net zero trajectory.
So important, and that's what some of us, like myself, have spent the last 30 years trying to do as well. And we're now starting to get regulation, and as we go through this event, we'll start talking about regulation in different areas as well. Perhaps, thank you. I need to read your report. But did you want to mention? Because I think you've put out some information on this recently, haven't you? So we'll talk about that in a moment. So Randeep, as a portfolio manager, then, so we need companies to change, we need investors to change. Would you like to give us a little bit of a talk about what you do and how that all works from your perspective?
Sure. Let's begin by saying it's happening. We want companies to change, and it's happening. So we ran a broad range of quality portfolios at M&G, and in 2021...
Mike.
Sorry. And in 2021, we Paris-aligned the portfolios. We didn't have to make any change to the investment philosophy. What we wanted to do, and what you look for in a quality business, is a company that can mitigate as much risk as it can going forward to ensure that it can continue as a growing return at the very minimum, but also grow its returns. And what you see, quality businesses and Paris alignment go absolutely hand in hand. The average age of a company on our portfolios is 100 years. They're all listed companies, 100 years. Ideally, we want them here for the next 100 years. If a company isn't taking Paris alignment seriously, it risks its own business in not doing so. So what we try to look for are companies that have set out targets to reduce their own emissions, that have external verification through groups like the SBTi in order to reduce their emissions, and then we monitor exactly what they do. And that way we have mitigated an incredibly important risk for these businesses to continue operations as they do going forward. And not only, yes, there's a little bit of a cost associated sometimes in doing that, but longer term, it's a cost saving for that business, so their competitive positioning will increase, but also, as important, they will maintain their social license to operate. So a quality business and Paris alignment go absolutely hand in hand.
Thank you. And Tessa, I'm doubting you. I don't think you're going to disagree with anything Randeep said. Would you like to add to that, though?
Absolutely. So I think we kind of occupy slightly different parts of the ecosystem, a financial ecosystem. But as you were speaking, Randeep, I was thinking what he said. But maybe we have a slightly different emphasis. So I'm part of the sustainability team at CCLA, and we really focus on stewardship and engagement. So there's really sort of three areas we think that's important. Firstly, by working in collaboration with other investors. So we're surprisingly a small fish. We're 15 billion in assets under management, but when we engage with larger groups of investors. So we're part of something called Climate Action 100, which represents 68 trillion. So companies are going to listen to that kind of body of investors. We also think, you touched earlier, Julie, on regulation. We also think when you're engaging, it's not just about engaging with companies. You've really got to be engaging with your regulations and policy that allow the companies to proceed in the kind of way we want them to. And finally, it's really about encouraging company action. So we really think about it as a sort of partnership with companies. It's very easy to go along with, well, you've done this and you've done that, but here's areas you're not doing and pointing out what they're not doing, whereas we really like to sort of stand shoulder to shoulder with companies, work in partnership and address the problems. And that way I think we can really see the momentum continuing.
And then they get to see that you're a longer term investor and that you're not about to disappear, hopefully, straight away. So that encourages them again, presumably.
Absolutely. That is one of our main focuses. It's about long-term returns.
Thank you. Dan, would you like to perhaps touch on then, if you like, the other end of the chain where we're getting down to end investors? I think Mathilde would like to come in. Sorry, Mathilde. Oh, sorry, Mike. Is that me? Is the mic getting tired or is it me? Dan, please. How does this touch end investors then, please?
Well, how does it touch the end investor? That depends on the end investor, because in many instances it doesn't. And let's go with a straw poll in the audience. This is where audience participation is mandatory. How many of you in the room have a pension? How many of you make any form of active decision about where the money in your pension is invested? about half of those. How many of you have a financial advisor? And and that's about 3 hands, 4 hands in a room of not that many people, but that is representative of the United Kingdom. 8.6% of adults in the UK use a financial advisor. Interestingly, 8.4% of adults in the UK own some form of high-risk investment, like cryptocurrency. So almost as many people in the UK own that type of asset as they do have a financial advisor. And it's indicative of a couple of things. One is a chronic lack of financial capability and understanding in the UK amongst the general population. And I'm preaching to the choir here because I can see that's not you guys. But if you study other westernized and significant economies, for example, in Hong Kong, 55.8% of people would pass a financial literacy test. In Canada, it's about 46%, and in the UK, it drops down to just under 30%. And there's just no engagement on the whole. So that's a whole different challenge. But where the rubber meets the road is that ultimately all of this great capability that the guys are putting into all of their funds is available, but it's which channels are the end consumers actually going to engage in order to make a proactive decision to do something. And if we're talking about how we actually turn the dial and make it significant, you've got, for example, only 17% of adults in the UK own a stocks and shares ISA, whereas a huge, significant amount more own a cash ISA, earning relatively nothing next to inflation. So the biggest challenge facing the entire market when it comes to further engagement in these types of solutions is apathy and lack of understanding and lack of financial capability. And by financial capability, I mean where understanding and knowledge meets the ability to execute and actually do something. And knowing both of those things is key.
Thank you. I think that plays to one of the points I quite often make, that the competition for this kind of area is, I normally say indifference, but it's probably low awareness, isn't it, Dan?
Yeah, it's low awareness, and it's also, in many ways, boring. I mean,
sustainability isn't boring.
Well, relative to watching whatever's on Netflix at the moment, it is.
Fair point.
And that's actually the challenge that the attention deficit challenge that we face, which is that all of the fantastic stuff that the guys are doing in their funds, nobody comes home from work of an evening and goes, do you know what, tonight I'm going to sit down and research a really good sustainable investment portfolio. That's what I fancy doing. On the whole, they come in, they deal with very, very busy lives, and then they're onto the black mirror and screened out in some way, shape or form. And finding a way in which to make people give a damn is actually the really most difficult part of all of this.
Too right. And which takes me beautifully to my next question. Anyone would think this was planned. So Mathilde, can we talk to sort of, big picture? Why does this actually matter that end people think about their investments? I mean, firstly, there's the basic point about getting people to invest at all, as opposed to just put money in a bank account or cash ISA. But big picture, does it matter whether or not end investors are thinking about this? What happens if they don't? What happens right now?
If we don't invest, that means that we won't have growth. And so the narrative that we tend to hear sometimes these days is that, okay, we cannot afford to invest in net zero transition because it's costly. But it's wrong. It's the wrong narrative. We have done just serious modeling at the OECD with serious data, and what we have found is that if you invest in sustainable things, companies, etc., if we have what we call the enhanced NDCs, that means enhanced ambition that is implemented, that is invested in, etc., what we get is stronger growth. So, and we get this growth now, not only in the long term, so we get better economies, we get, of course, better health, better well-being, but better growth first, and that's what, is needed. So I think in the current context, this new research is quite important, and we get this growth in all type of countries, including our developed countries, but even more in developing economies.
Who would be the most affected if climate change spirals out of control? If we start heading to plus 2, 3, 4 degrees, and growth, the narrative that this is anti-growth is just completely balmy. Just in case there's anyone out here who's reading such media commentary, it's the opposite. It's the complete polar opposite, clearly. And I'm sure Mathilde's report probably spells that one out, I would imagine. Tessa, can I come on to you for a moment then, please? So from across the markets, what are the implications here? What are we looking at of success versus failure in the general area of sort of why having climate-friendly portfolios matters from a macro perspective?
Well, it was interesting, talking about how do you get people engaged and interested, which was one of the earlier points. We go out to our clients on a 3-year basis, and I have to say, even though regulation and things may be, I can't remember if it's a tailwind or a headwind, but things not going in the right direction, it certainly isn't from our clients, and they may be a bit more of a self-selecting group. But when we were asked, do these issues matter to you? And that's given that, we're giving them a good financial return to start with, so that's the kind of the level playing field. But then, do these issues matter to you, and what are your views on them? And their views are, yes, they do matter, and even more so than a couple of years ago. So I think climate change is beginning to bite on people's consciousness, and there's a real awareness that, you can do something about it through your investments, which is probably the biggest impact you can have. And then it's up to us as fund managers to say, given that, how can we really show you that your investments are making a difference? And I think that's the more challenging area for it to be meaningful.
And Randeep, that brings us on to one of people's most common fears. And I know, look, markets are cyclical and things go up and down over time and nothing's predictable. And we didn't know what was going to happen politically. We'll come on to that in a moment. But performance-wise, is it okay? What performance implications of looking at switching across, focusing more on climate? Does that damage performance?
Well, the proof is in the pudding. I mean, look at the fund performances over time. In fact, if anything, it enhances performance. Companies can get a very quick payback when it comes to reducing costs and reducing emissions, 2 to 2.5 to 3 years. After that, you're at a cost comparative advantage to your competitors. You're also sending a very positive signal to investors to say, as I discussed previously, that you're actually thinking and investing for the future. That we are a business that understands what sustainability in all matters of what we do is important. So that's how we make our decisions. Rather than focusing on quarterly EPS, we're investing for much longer term. So we haven't seen any sort of detriment. Now remember, think about what it is that when you invest, you're trying to maximize your maximize your return and minimize your risks. And you need to try and find a balance towards that. And in minimizing your risk, you want to ensure that companies are looking at emissions. From a regulatory standpoint, they become more and more important. The longer you leave it, the harder it is to try and catch up. And then you also have the negative possibilities of fines, regulatory scope increasing, and that license to operate effectively disappearing.
So longer term, the performance drag is greater the longer you leave it. That's
exactly
more negative. Tessa, can I come to you for a moment and just come back to you briefly? I think we're going to touch on the mechanics of how a fund manager might deal with something like this. We'll just start for a moment just to explore. I tend to talk about avoiding particular assets and positively selecting other assets, but then influencing companies and engaging with companies, so what we call stewardship sometimes. Would you like to just kind of introduce that concept? So we've got the mechanics of how this actually works. What do you do on that side?
Absolutely. So we do have a sort of base level. We don't call it avoidance, but we do avoid companies where we think there are greatest risks, and we do screen for a basic level on that. But then in terms of when we're engaging with companies, as Randeep, as you said, it's really looking at that risk aspect. We want to know that these companies are geared up to deal with the challenges of climate change. So it's very much about, have you set a credible climate transition plan? What are your targets? And we like to see almost a sort of a visual representation. I love that, where do you expect to be by 2030? where do you expect your emission reductions to have come from? You know, low-hanging fruit tends to be energy efficiency, but renewables, other aspects. And if companies are able to model that, we know they've got a strategy, we know they've got a handle on where they need to go. So it's about having that partnership with companies and then having the tools and the frameworks to sort of work in partnership and help them as well. For example, looking at things like, have they considered climate change as part of the executive remuneration? So we know when the directors are being paid, this is an area that they'll be rewarded for doing.
So who are you talking
something.
to when you do that?
It depends on the company. So you can speak at board level. Most recently we were speaking to the audit committee chair when we were talking about having climate risk into accounts. That was with Unilever. With some companies that are behind the curve, it might be investor relations. And sometimes it can depend on the topic, but often it's the head of sustainability or you know who we've got the contact with. So,
thank you. Let's come back to if you like the other side of the equation, which is the end investors again. Maybe Dan. So the Financial Lives survey, the most recent client research that came out from the FCA, said that 72% of people, now bearing in mind that's a reduction from 2 years ago when they last did the research, but 72% of end investors have said to the FCA that they want to invest to do good and get a financial return. Now clearly these funds are dual objectives, that's what they set out to do. They focus on sustainability issues and they have to generate performance, otherwise why would you invest? But so we've got a massive groundswell of people who are interested in this. I wondered, Dan, if you could perhaps, talk on how else, retail investment community and thoughts on, is that getting through? Is it working? How do we look at that?
It isn't getting through and it isn't working because there is a disconnect between if 72% of the population think that they want to invest in something that does good and gets them a return. The problem is when the rubber meets the road of what does do good mean and the practicalities of then turning that into an actual decision to purchase something. So I think that I would like to invest in something that does good and gets me a return. In my mind, I know what does good means. For me, it might be I don't want to see investments in petrochemicals and I don't want to see investments into tobacco, whereas I'm not that bothered about ammunitions, etc., whereas somebody else will have a totally different opinion. So the problem becomes in terms of interpreting everybody's do good into the actual decision to purchase something. And then you've got the access problem of, right, I think I want to go and invest in something that's going to do good. Where? How am I going to find that? If I'm a DIY investor, can I go on to one of those self-investing platforms like a Hargreaves Lansdown or an AJ Bell? Can I find the stuff that I want in a way that is presented to me with information that allows me to understand that that's what I want? Or if I'm working through a financial advisor, can I articulate to that financial advisor what I want in a way that allows that financial advisor to find a supplier of funds or a portfolio in a way that means that I'm going to get something that fits me? And it's the disconnect between the consumer's wants and the really, really difficult, minute detail of working out whether a fund's going to buy that particular stock or that particular company because of these criteria. And it's non-trivial. And all of that within a really highly regulated environment where you've got a regulator, the FCA, the Financial Conduct Authority, turning around to everybody involved and saying, don't you dare go and invest in something that's not on the label of what you've got on your fund, or Mr. or Mrs. Financial Advisor, if you pick the wrong thing for that person and we interpret that what they said over here wasn't exactly what you put them into over there, then, oh boy, we're retrospectively going to get you in a lot of trouble. So what you end up with is the path of least resistance, which is don't engage too much, make it as simple as and vanilla as possible, and don't have that specificity of what the end consumer wants.
So I'll jump in at this stage and say that Dan is one of the people on a committee that I vice chair, basically set up by the FCA to explore what we do in this market, in the financial advisory market, where we're trying to create a framework for the financial advisory markets to make sure this does get out to people. But Dan's absolutely right. Advisors have got a million things they've got to do, and as soon as you get into things that are difficult, it's hard and it becomes extra work, which means having to charge extra money for your time, etc. I'm also tempted to say they could just use Fund Eco Market, our database, but I've only been doing it 15 years, so why would anyone know about that? Anyway, so can we start to explore some of the pressures that are sitting behind the scenes? Perhaps I'll start with just maybe a few thoughts from you, Dan, and then maybe move on to Mathilde and Randeep around, there's a lot of noise, isn't there, in the background that doesn't really help to encourage people to talk about sustainability. And I don't think financial advisors, planners, wealth managers, etc., are immune to some of the geopolitical noise that we're hearing. Do you think that has an impact, Dan?
Yes, I do. In the long run, probably not, but I do in the short term. And I think that but it nowhere near as much of an impact as performance does. And if you look back over the last couple of years, the amount of investment, and I currently work for a business that oversees recommendations of about 50 billion of client recommendations a year through financial advisors through some software. And what you've seen over the last few years is that the amount of investments being recommended into sustainable investments is steadily slightly down. And it reached a peak in about 2021 when it peaked up. And what did you notice in 2021? The top 4 performing funds in the market were all sustainable because the types of things they were invested in were doing very, very nicely indeed. Now, everybody knows that you shouldn't buy high and sell low because the maths will tell you that's not going to be very good for your portfolio. But human behavior says, wow, that's all going up. Oh, look, it's going up and I can feel good about myself. I'll invest in that. And then it starts to go not perform as well. And then they start going, oh, you know what? Performance drives behavior over and above those underlying principal criteria in many ways. So yes, there's a bit of geopolitical noise and whether or not certain people over in the States are in favour of this type of thing. But on the whole, it seems to be that performance is what drives client demand or not.
Yeah, big subject. We could talk on that for 3 hours very, very easily. Another factor being flows out of equity funds generally have been pretty high as people have got spooked. So there's not just one factor that's driving all of this. And of course, a lot of people will have realised that the funds that they bought weren't necessarily doing exactly what they thought they were, hence all the new regulation, which we'll come on to next in a second. But the need for regulation was very clear because people were making claims that you wouldn't make in other walks of life, and now people know they've got to be clear, fair and not misleading for sustainable funds as well, which about time too. They were always meant to have done, but they didn't. So maybe Mathilde, can I talk to you about some of the areas going back to the geopolitical bit? Some areas have been a little bit more under attack than others. Have you got any thoughts on particular areas, like be it the stewardship agenda or different areas that you've seen that concern you?
Clearly, we know that environment in general is under attack, not from everywhere, but from some big places, I would say. So yes, it does. It's not only noise. I mean, it does have an effect because the investors, they need some clear signals. They need some clarity of the direction of travel from the governments. And here there is no clarity. There's a lot of confusion. Where are we going? A lot of contradicting signals, etc. So this is not only noise, it's having a negative effect, but at the same time, somehow the reality is that this has become good investment, as you said. So somehow the train has left the station and there is economic evidence that it is good investment. So this will continue one way or the other in spite of the contradictory public policy signals. Yes.
They need those signals to be sure that they can invest to do things differently at all the different levels of investment through the chain. And maybe if I can come on to Randeep and Tessa, if you can say briefly, does that the whole geopolitical backdrop thing realistically does it impact your businesses? Are you seeing fallout from that as well?
Why don't I start with that? I mean, and as I stated, we run Paris-aligned portfolios, so we can actually look at data we can actually look at data of companies that are getting externally verified carbon reduction targets in place. At the end of 2024, just as President Trump was elected, it was about 5,500 companies. By the end of May this year, it's well through 7,000. It hasn't slowed down whatsoever. Not a single company that we own or look back is walking back any of their targets. And to be quite frank, why would they? You have the administration that's been in, will be in for 4 years. Who knows what happens after that? If a Democratic administration were to come in, chances are the first thing they will do will sign the US back up to the Paris climate deal. In which case that company has lasted 4 very vital years in trying to decarbonize and get the infrastructure in place in order to do that. We also invest in global companies, so it's not just about the US. You have operations and customers in Europe. You have them across Asia. The appetite there hasn't slowed. If anything, in Asia, it's actually warmed up. 31% of companies today that are submitting targets to reduce their emissions are now Asian. That is much higher than it was even just a few years ago. So we're not seeing any pushback. You see a lot of rhetoric. And you've seen some hydrocarbon companies, i.e. the big oil and gas companies, that probably were never going to make it anyway, find themselves an off-ramp, which is a very easy excuse to say the US administration is now saying this, so we're going to do it. But in practicalities, companies are pretty much staying the course.
Tessa, please.
Oh, I could just add briefly. I think I keep saying I keep agreeing with you, Randeep, but I agree with that in the main. I think we have to see the US as a different kettle of fish, and maybe to come from it from a slightly different angle. We had 2 company engagements last Friday, and I think they illustrated some of the problems that companies are having from geopolitics. So one of them was, I would say, a less good performer on climate, and it was adopting a bit more of a let's wait and see. And I didn't spend too long arguing the case with them, although I provided case studies of what their competitors were doing. And wherever a company is, they always want to know what their competitors are doing, because that helps them from a competitive advantage. The second company I found really interesting, which is, I'd say, one more of the leaders, and another investor on the call say, we always like to talk about you being very good on these issues. I'll try not to get into the weeds too much, but they'd based really a lot of their business on the Energy Star program, but with all the different changes in legislation, they weren't going to engage on that at all, because there's so much change going on, and they were more engaging on bottom line issues like refrigerants that they can use in their products, which the specification is being changed totally. So it's almost like companies are having to prioritise where their efforts are, but the impetus behind it is very much still there, and these are the good companies who are going to maintain their position.
That's brilliant. I mean, the point.
Julie, can I just add one very quick thing on it? I mean, the US gets talked about a fair amount. California has not dropped its net zero targets. Neither has the state of New York. If you're a tech company, and all the large tech companies are based in California, you still have to follow the law of your state, or you can move to Texas. New York State, another very large state, the state of Illinois has not dropped its laws on net zero. So a lot of the large global multinational companies are based in some of those states. They cannot legally drop it, nor do they want to when we have the conversations with them.
That reminds me of 5-6 years ago probably more than that, when we had the We Are Still In campaign. East and Western Seaboard both saying we're not changing. Why would we exactly? So hopefully there's lots of we are still in sentiment still going around. And these are the kind of messages I think are so important that we get out to people. Because it's very easy to think, with some people dominating the media so much these days and all the negativity around war, etc., a lot of companies just haven't changed.
I was just going to say, I think the We Are Still In campaign is still there, but it's now called the America is Still In. And so a lot of these things, the impetus remains. It's just terminology that changes
Didn't know
around
that.
it. Yeah.
Okay, so one or two people have touched on the need for regulatory certainty. There's been a lot more regulation that's come up affecting sustainability in portfolios, etc. Some of you will know I've been very involved in the SDR stuff really for the last 5-6 years. So developing the UK regime, but it's obviously not all about the UK. We're just one corner of the planet, if you like. But maybe if we can all just touch on sort of key aspects that we think are important there. And again, well, maybe, I mean, Tessa, shall I start with you rather than starting with Randeep this time? And just talking about...
I agree with her.
Yes, exactly. We can turn the tables on that one. So regulatory certainty and, the key things that matter to you on that area.
Okay, so
Introduction, perhaps.
you were saying there's the UK regime and there's also the EU regime. So, and Julia, you touched on a bit. We now have the labelling for different funds. So I think that gets rid of a lot of the greenwash that people are concerned about. Yes, this might be a good green fund, but is it really? So even funds that aren't going for a label, there's much more impetus about having a sort of rigorous way of showing that you can really make a difference. So we all like to talk to anecdotal examples of companies we're engaging with now, but we have to have a much more structured way of doing this. But again, the other point I think is worth saying is a lot of regulation is being rowed back. So the EU was very strong. It had, I hate acronyms, but CSDDD, the Corporate Sustainability Due Diligence Directive, and the CSRD, which is the Corporate Sustainability Regulatory Directive, Reporting Directive. And they've been in place for about 4 years, and companies were really geared up and providing excellent information. Even US companies, because if they have operations in the EU, they have to report. And it's provided incredibly detailed and useful information for investors. But there's now something called the Omnibus package that's seeking in one way to dilute this quite a lot. It's now only going to apply to, instead of companies with 500 or more employees, it's now going to be 1,000 or more. And recent moves suggest there's moves in the Commission and the Parliament to move it to companies of 3,000 or more. And what that really does is it stops that level playing field. So you get the companies who are giving out great information, investors can rely on it. And where regulation draws back, that's a real danger. So that's really where our role as investors is to jump in and go, look, these are great standards. This is the kind of information we value and would like to see.
Gosh, and you can see companies deciding to split into separate entities as a result of that kind of thing. You can see quite strong responses if it goes down that route. My first reading of that was thinking, well, to some extent, I've helped design the SDR rules in the UK, and I see some of the bits that have got more complicated than we originally intended, because they've gone beyond helping clients because they've got too technical, whereas I want to solve the problem with clients to build trust, etc. But is there anything else either of you, as the fund management end of the panel, would like to talk about on regulation?
I mean, let's talk about SDR for just one quick moment. It has been helpful. When we launched the Paris-aligned funds, we had a lot of companies or competitors out there, or peers, that also called themselves Paris-aligned. We could look at their portfolios and think, wow, that'd be an interesting company to hold. There is no way we could get it past our own compliance checks or our own investment process. Once we've gone through this SDR process, those funds have effectively either changed what they hold or they no longer call themselves Paris-aligned. So I do think that the regulation is working. When you leave it up to, when it's a subjective matter for someone to decide what is or is not Paris-aligned or sustainable, you get a lot of different answers. When you have a minimum criteria and you hold yourself up to transparency, it does change the playing field for the better. The CSRD part, I'll touch very quickly on the EU, it is a little bit of a backstep. Now, the EU has issues. The EU has looked and said, we have no new business startups within Europe. Compare that to the US, compare that to China, especially when it comes to technology and AI. Why are we so far behind? And they believe that they're over-regulating businesses. So the Omnibus package effectively tries to roll back some of the regulatory and reporting burden on companies to say, look, if this helps start a business here, rather than moving somewhere else to do it, let's try and give you that space. What would be helpful if the likes of China and the US were to step up their reporting requirements? We were getting there under the Biden administration. That's gone back a little bit. But just to Tessa's point, if it stays at 1,000 companies, it won't have that much of an impact, especially at the companies that we look at. Certainly no one's going to go backwards in terms of what they do. And hopefully if it does ignite some entrepreneurship within the EU and the UK, it might be helpful. But we're not at this point seeing many companies saying, well, if the EU doesn't want us to do it, we're just not going to do it.
Thank you. And Dan, can I come back to SDR rules where we're talking about anti-greenwash and labelling? Have you just briefly a gut feel, good, bad, indifferent for retail clients and the intermediary market here?
A step in the right direction, probably not achieving the goal that it was set out to achieve though. And for those who don't know and aren't in this world, the goal that it was trying to achieve was effectively the same as going into the supermarket, and if you see a foodstuff that says it's organic, you know that there's a reason that they've been allowed to say it's organic. You go back 10 years, the Food Standards Agency was like, everybody's calling everything organic in the supermarket. So what does that mean? And then they created a rule that said, if you're going to call that food stuff organic, you're going to have to reach these standards to put that label on it. So what the FCA have done is create some labels for investment funds that says if you're going to call it that, you're going to have to prove these things so you can have that stamp on it. And they've got these fairly generic 4 labels that are available. And it, I think, I won't speak for the guys, but it's proven difficult to get through that process to get a label. My daughter's in the audience, and she's just done her GCSEs, and if her teachers had told me that in her mocks she'd got some stuff wrong, but they weren't going to tell her what was wrong, she just had to keep coming back with more answers until we got the right answer, you would say that that was utterly ridiculous. That's what the process was like with the FCA, unfortunately. You want that label? I'm sorry, you're not right. Why? Can't tell you that. Just come back later and we'll see if you've got it right then. So that's one limitation of it, is the number of funds that are getting those labels on. So you've got less of a supply chain to go at of stuff that might meet your criteria. The other slight downside of it as well is that, and this harks back to the point about regulation as a whole, there is at the moment a slowing of regulation because the government in particular don't want to be seen to be stifling growth. They need growth to come from anywhere. So therefore they're going to slow regulation an awful lot. And what they've done in the financial world is they've said, right, we put these labels on the funds, we're not going to put these labels on the portfolios for now. And by that, what we mean as a fund is one fund, but you can build a whole portfolio out of lots of funds. And they're not going to put a label on those portfolios. It's a little bit like telling you that the flour is organic, the sugar's organic, the chocolate's organic, but we're not going to tell you whether the cake's organic or not. And that's the equivalent in the financial world is that fund is, that fund is, that fund is. I'm not going to tell you whether this overall portfolio is though. We're not going to apply the same rules.
So I'm going to jump in briefly and say that whilst I've spent most of the last year telling the FCA what they need to change, having helped them build the thing in the first place, the answer that I think they might give, and I don't know if there's anyone from the FCA in the audience here right now, but you know, Rome wasn't built in a day, and they've gone through this massive learning curve too. And there are things that have worked and things that haven't worked, and there are also other things that the FCA can't influence as such, like offshore funds are not allowed to use labels, SDR labels yet, because they're not in scope, and that's down to the Treasury to sort out. So the FCA can't do that, and you can't really move forward on portfolios until the offshore stuff is sorted out, unfortunately. But I spend far too much of my life talking about SDR. So let's talk about some real things. I think when we were talking the practice sessions, we thought it might be nice to spend a few minutes. We've only got 10 minutes now, but can we just do really quickly, because I did want to allow time for Q&A, but it's a fairly small group, so I'll perhaps just ask Mathilde to start. I think we talked maybe plastics, was it? And just one or two things, just good examples of things that really are changing in business, some of the projects that have involved, that have worked, or if you'd like to kick off, or someone else can kick off.
Well, maybe not in business, because that's not my business. It's more in public policy. I mean, there is a big thing that might land somewhere very soon. It's the plastic negotiation at the international level. These days it's difficult to agree on anything at the international level, but we are very close to agree on a plastic treaty. And this would be a big thing. And if such treaty would cover, the whole life cycle of plastic from production to waste. So I hope this will happen during the summer, and this will be a big change in the overall regulatory framework globally.
Wouldn't that be wonderful? I'm going to keep my fingers crossed for you. Hopefully you'll tell me how that goes, and hopefully we'll see it all over the media. Tessa, would you like to come in?
Oh, I'd just like to say I think it's a fantastic initiative, and as investors we've been supportive of that and written to say so. I think it's we're allowed a minute on a quick plug of something we think is relevant. So for us, we're going into the 5th year of asking companies to put their climate transition plans to vote at AGM. So if you own any single stocks, you might see a resolution at the AGM. And we think it's really important that companies set out what their strategy is, that they can allow shareholders to view if they think it's credible or not, that they can say, well, it's going to require this new technology, so we're going to need to put this amount of capital towards it. So we've seen progress on it now. 20% of the FTSE 100 have done such a vote at the last AGM. And we think it's just really effective in getting the conversation happening, not just for companies that are seen as green companies, but across the board.
Thank you. And anyone else would like to have a final plug for different issues or projects that are ongoing? Or should we move on to the question about what next?
Let's move on to the next question.
Okay, let's move on to the what next. And if you could, while we're talking, if you have questions in mind, just start formulating them, and we'll do fantastic. We'll do a quick round of what next, if we may. Dan, you look like you might be ready to answer a question.
What next in terms of?
What next in terms of climate-friendly portfolios? What needs to happen in order for them to succeed, take off, move forwards?
We need the public, on the whole, to increase the demand on all the different channels that they could possibly access these solutions from. If more people are going on to self-select DIY investment platforms, or they're going to their pension provider in their workplace and they're making the decision to do this, if more people are talking to their financial advisor about it, then they have to engage and select from the supply chain in order to do that. It's, in my mind, along with the entire growth agenda of financial services in the UK, this is inextricably linked to increased financial capability in the UK.
And you're going to get that sorted in your next business?
Anybody would have thought that's what I'm about to start a business doing, but that's for another day.
I look forward to hearing more. Mathilde, please.
What next in the area of public policy? It's, as you said, watch Asia. Now, Asia is the next champion. Europe has been so far, but Asia is the next champion. And watch the subnational level. You said about the states in the US. So there are new coalitions now between the business, subnational levels, so different type of actors, coalitions that will move the dial.
Fantastic. Randeep?
What next? End the pessimism. It's that simple.
Yes.
You know, progress is still continuing. I think we touched on earlier in terms of the differential between investments in fossil fuels and renewables. It's the highest, the delta or the differential is the highest it's ever been, 2.5 times. As much solar went into the system last year to power Germany for an entire year. We keep moving forward. China keeps setting targets for renewables and keeps on going through them. We see companies continuing to decarbonize. Their ability to decarbonize continues to grow because the infrastructure continues to go into place. I think we've got ourselves, it's probably an easy story to write that, this was so successful and everyone was talking about it a couple of years back. It's still continuing in the background. And to be honest, it's not such a bad thing that it doesn't capture the headlines every day quite the way it used to, but the pessimism that seems to be attracting also needs to go away.
I think that talks to the geopolitical noise, doesn't it? That it's just gnawing away at all of us. And it's so good to hear the positive stories. I think it matters so much, and I really hope people take that away with them. Tessa, please, just briefly, and then we'll come to this gentleman at the front with his question.
Absolutely. I think you're right. We know the direction of travel. We know where the momentum is. And I think for us as investors, it's really to be aware of not only engaging with companies, but engaging in the policy dimension. And also an area we've really focused on is what companies are doing in terms of trying to influence policy. And not only that, but what their trade associations are doing, because often their trade associations are the ones that are lobbying against really good regulation, against what the companies are doing themselves. So, continue the good work.
Just like that. Thank you. Brilliant. Let's come to this gentleman at the front with the question, please.
Yeah, thank you very much. My name is Ben Lane. I'm a senior consultant at Small World Consulting, based in Lancaster University. I'm really intrigued. Thank you for the conversation, everyone on the panel. I'm really intrigued by this this linking of regulation and growth. My previous company, I was co-founder of ZapMap, and we built a company from nothing to a very valuable company that we bought by Good Energy. And we, as a new company looking at new energy and promoting EVs, we wanted regulation. Regulation set the bar high, and we wanted to jump. What stifled our early days was money, not regulation. What we needed was seed funding of 1 or 2 million. And even now, I'm now at Small World. We have a new project, and I'm really happy to say we're at the beginning of the development cycle. We have a project that we're looking for seed funding. We're back into the same game, and we're getting that seed funding in the UK is a non-trivial process. It's not the regulation that's the problem. It's not the high standards. It's money.
And I think the lack of regulation here was a major issue, which is why I was pushing for regulation, because although genuinely I think there's been teething issues, the need for regulation is solid, because if we don't build trust, we can't move forwards. Does that ring bells?
It does, but I think, just hearing the panelists talk about European regulators backing off regulation to allow more growth, I think this is a false paradox. I think what we need is really good sources of funding, and you represent a significant amount of wealth for investment to actually identify really good projects and take risk. I think in the US they have the investment risk balance better than in Europe. Fortunately we're in Europe for very good reasons, but the only downside is our perception of risk, I think, isn't maybe what it should be. I mean, I'd be really interested to hear what the panelists think about how we deal with risk if we want to generate growth.
So there is a... I don't disagree with you, by the way, about the notion that regulation shouldn't stifle growth. But there is a problem in UK PLC around liquidity and lack of liquidity in investment markets. And I'm currently on the exec of a business that's listed on the alternative investment market, the small version of the FTSE in the UK. And it is incredibly difficult to manage a business when there is a lack of investment flow, there's a lack of liquidity in people wanting to buy those shares, and therefore the people who hold them knowing that they're going to be able to sell them when they want to. And that is manifest across the country. And therefore there is an outflow of businesses, in some instances delisting in the UK and going and listing overseas, in particular in America, where... And it's not just financial regulation. It's not environmental regulation. It's across the board. Just that risk-reward dynamic for the amount of regulation that is there means that the capital flow hasn't been coming to the UK, and that's the bit that the government know they've got to do something about. And if they continue to write more and more regulation across environmental standards, across financial matters, and across governance standards, etc. On the one hand, they are petrified that they're going to further strangle the flow of capital into the country. So it's not necessarily that an individual business can't thrive. It can, because there's regulation that says that's what you need to do, and that individual business goes and knocks it out of the park relative to that regulation in their market. However, the chances of that business getting investment is strangled because the capital's not flowing into the country as a consequence.
So then the issue is on the investor side, not the recipient.
Correct. Yeah.
Interesting.
Any other comments on this?
I was just going to make 2 quick points. Thank you so much for that map. I think without it, as an early EV adopter, I wouldn't have gone the distances I did. I absolutely relied on that. So fantastic business. And secondly, just a very small point on regulation. We, alongside a number of other investors, wrote, saying we don't think the EU omnibus should be as draconian as it is. Of course, it should be streamlined. Of course. It should be simplified, it should be aligned with the international standard, it should be easier to report, but not to water down those sustainability requirements. So we weren't alone in thinking that.
Yep, fantastic. Any further comments on that? Because I think slightly different but similar views that can meet in the middle, I think, what we've just heard there. Randeep?
I'll be very quick. So 2 points on that. First of all, regulation and bureaucracy can be two different things. Regulation is the bad thing, but sometimes the bureaucracy that can go alongside it and also just hampering decisions and making them slower is some of the issues that we have in Europe relative to the US. And the second point is a regulation going back to the 90s on what we can do with pensions and the liability matching and making sure that volatility and risk is kept at a certain level. But what are huge pools of capital and long-term capital at that has also held back how those pensions can invest. Now, a government can come in and change those rules, but no one's really had the foresight to do that yet.
Mathilde, would you like to add anything, or should we move on for further questions? No. Okay, are there any other questions here? I think we've probably got room for one last question over on my right here.
Hi, I'm Tegs. I'm a professional trustee. My question is on climate-friendly portfolios, and have we been focusing on the wrong metrics? By focusing on low-emitting companies with low emissions intensity, the argument is that in a world that's transitioning, you're going to get stranded assets. Those companies aren't going to perform as well, and that's why it's going to be a financial risk in portfolios. But that's not what we're seeing. If you look at global emissions and what they've done in aggregate, in the real world, not in people's portfolios, they've gone up every single year since the Paris Agreement was made. And yes, there's been great progress in renewables, and some geographies are doing better than others. But what we've seen is the demand is going up such that the energy mix isn't changing in the way that we'd kind of envisioned. And I think we're just focusing on the wrong companies. It's not the high emitters that are going to do badly in the future. It's those whose supply chains are going to fall over, who don't get insurance, who are operating in areas of water scarcity. And what we don't have is portfolios constructed in a way that looks for those winners and those losers versus just a blind focus on emissions intensity.
Thank you. I think this has got Randeep written all over it.
Well, let me begin by saying, first of all, we don't just concentrate on the low emitters. We look at the whole chain of emissions, and the key criteria is companies that have got targets in place in order to reduce their emissions. So we have some very high emitters on the portfolio, but what's key is they have targets to reduce their emissions, and those targets are externally verified, and then we monitor what they do year on year. You're right in saying that the emissions have gone up year on year, but the population has increased year on year. Economic growth has increased year on year. Imagine if we didn't have this and we weren't putting renewables into the mix, what those emissions will be today versus what they would have been had there been no Paris climate deal 10 years ago. Now, the US and Europe have already hit peak emissions. It looks as if China will hit their peak emissions a lot quicker than we expected. I think we're likely to see a big announcement at Belém at the latest COP by President Xi. So I think China is actually seeing that in order to be competitive going forward, that it needs to direct its state-run utilities to invest more in renewable energy. And literally week after week, month after month, they are hitting those targets in order to get that in place. I think we're probably just at that curve now where we start to see it come down, but there will be a part to play by everybody. Large companies, small companies, low emitters that will grow, high emitters that will continue to bring their intensity of emissions down. And we're continuing to see that across the board. And that piece that we touched on earlier, Asian companies were doing very little when Europe and the US were starting to get their emissions down and to put transition plans in place in order to get their emissions down. In the last 18 months, and specifically the last year, they have really, really stepped up now, because I think that they can see that if they don't do anything, they're effectively going to get left behind.
Thank you. Can I just ask if anyone wants to say any quick comments, and then maybe just one or two, if anyone wants to say any burning points that you've missed that I've skipped over or anything, but we do need to close, so if we can just say...
In conclusion, I'll say that the lady over here is the professional trustee, has just encapsulated the entire suitability problem in one fell swoop, which is professional trustee wants an investment that operates in this particular way, but finds that some of them are operating in that particular way. Flip that away from a professional trustee, a self-employed plumber who's got a self-invested pension might want a particular solution that's invested in one way. How the hell's he going to find something that matches up with what he wants?
Good luck to him. Yep. Any other comments or any burning comments that you wanted to say that I've not given you the opportunity to say before we close? Please go ahead.
Maybe a very short comment, because I think Randeep went in great detail. But when I was thinking about today, I was thinking, what's the main thing I want to say? And I think you put your finger on it completely, which was, it's about helping companies decarbonise, not picking decarbonised companies. And if there's any kind of call to action, it is, what are your values? What are you looking for? And how can you look for that in your investments? And labelling may help, but you've at heart got to know what's the most important factor for you, and do a bit of homework and hold our feet to the fire.
Perfect.
And maybe just to support what you said, there are 40 countries which have decoupled, growth with emissions. So, and the Asians are getting there.
40, that's a good number.
40 countries have decoupled growth and emissions.
And are they all small, or are they different sizes? Or?
Well, the developed ones, so different sizes, definitely, yes.
Really interesting. Any other final comments, or do we close?
I was just going to make that point as well. You do have countries now that have decoupled growth In fact, the more they grow now, the quicker they decarbonise because they've got the capital in order to do it.
And lower energy costs, presumably, as well. Cool, fantastic, as part of that mix. So it remains for me then to say thank you very much for being with us. This is the last session of the day, so I appreciate there still being people here. And if we could thank our panel, thank you guys.
It's been emotional.
Thank you. We're happy to stay here at the front for a few minutes. If anyone wants to come and ask us questions, you're very welcome to do so. Thank you.